My name is John Bogle. Many people later called me the father of index funds, but I have always preferred to think of myself as a simple reminder. Because in markets, the most expensive price you pay is often not the loss itself. It is getting the concept wrong. The longer I stayed on Wall Street, the more I realized something. People do not lack information. If anything, they have too much of it. What they truly lack is a map. A map that shows where they are, what roads lie ahead, and where those roads actually lead. Over time, the S&P 500 index and ETFs became two of the most popular words in investing. And the more popular they became, the more easily they were misunderstood. Many people began to believe that buying the S&P meant buying the market. Others started to treat ETFs as some kind of smarter, superior asset. So today, I want to answer one question in the simplest way I can. When you say, "I am investing," what exactly are you buying? Let's start with the first thing: investment choice. Most people think choosing an investment means picking a ticker that will go up more. They choose the way someone picks lottery numbers. The more exciting, the more popular, the better. Ideally, it feels like, I know what others don't. But in my view, what you are really choosing is not a ticker. You are choosing an exposure, the specific source of risk and return you are willing to live with. Let me put it plainly. When you buy an individual stock, you are exposed to the fate of that one company, whether it succeeds or fails. When you buy a sector fund, you are exposed to the cycle of that industry. When you buy a country's broad index, you are exposed to the competitiveness of that country's businesses and to the strength of its system. When you buy a global index, you are exposed to the world's growth and rotation as a whole. So investment choice is not, which one do I pick? It is, which story am I willing to hand my future to? I have seen too many tragedies because investors never ask themselves that question. They see something rise and they rush in. It dips a little and they panic. It rises again and they chase. They believe they are managing wealth, but in reality, they are simply running with the noise. That is why I often break investment choice into 3 layers, so the picture becomes clear immediately. First, are you betting on a company or a system? A single stock is like betting on one ship. An index is more like betting on the entire shipping network, perhaps even the trade routes of the sea itself. Bet on a ship and you might double your money, or you might sink. Bet on a system and you move closer to the long-run average. Second, are you betting on one era or many eras? A single theme is often a bet on one era's narrative, and narratives expire. A broad index is more like betting on the human economy itself. Today it is energy. Tomorrow it is technology. The next day it is healthcare. It rotates, but the whole keeps moving forward. Third, are you betting that you are very good or that you can endure? The market loves to seduce you into the first bet, believing you are exceptional. But the people who truly win over the long run tend to place the second bet. They can endure. At this point, you might say, "All right, Bogle, I understand. I don't want to constantly trade. I want to be closer to the market. What should I do?" And that is when most people turn their eyes to one name, the S&P. I understand why the S&P is so appealing. It is simple. It is famous. It has a long history. It sounds like a promise. I don't have to pick stocks. I will just buy the market. But I need you to pause right here and hear one key sentence. The S&P is important, but it is not the market. This is not nitpicking. It is about boundaries. When you don't understand the boundary of a tool, you fall into an illusion. I often use a metaphor that wakes people up instantly. The S&P is like Fifth Avenue in New York City. It certainly represents the heart of American capital, but you cannot say Fifth Avenue is America. The market is a much larger word. At the very least, you need to know what the S&P leaves out, because what it leaves out may be the winner in a different decade. First, it is not every size. Large cap stocks are not the entire market. The S&P is mostly large companies, but the market also contains mid-caps, small caps, and micro-caps. In some years, the giants dominate. In others, smaller companies are more flexible and more explosive. When you buy the S&P, you are choosing a large cap tilt. That is not right or wrong. It is a trade-off. You should simply know what trade-off you are making. Second, it is not global. America is not the world. Many people use the word market when they really mean the U.S. market. But the world contains many economies, many currencies, and many industrial structures.
That is a choice. It is not the market itself. I have seen investors make an unconscious concentration mistake. They think they are diversified because the name sounds broad. The S&P. But in reality, their fate remains heavily tied to the United States. Third, it is not evenly spread across industries. The index can be far more concentrated than you imagine. The S&P is market cap weighted. Bigger companies carry bigger weights. When an era is dominated by a handful of giants, the index becomes more concentrated. You think you are buying 500 companies, but your returns can be driven by the top 10 or 20. This is the most common misunderstanding. How can it be concentrated if I own 500 companies? Fourth, it is not everything beyond stocks. The word market also includes bonds and cash. They may not feel exciting, but they often determine whether you can survive a storm. I am not telling you to buy bonds today. I am simply saying this. When you say the market, you should know which layer of the market you are referring to. By this point, many people feel relief because they finally understand one simple truth. The S&P is a powerful core puzzle piece, but it is not the entire puzzle. And now, you watching on the other side of the screen might ask a smarter question. Bogle, if I want exposure to the S&P, how do I actually buy it? I can't buy an index directly, can I? That brings us to the third part, ETFs. I've heard the word ETF discussed so often that it almost sounds mystical. People talk about ETFs as if they were glowing assets. But I want to bring it back to something plain. An ETF is a packaging method. It packages a basket of assets into shares you can buy and sell on an exchange, like a stock. You can't buy an index directly. An index is like a ruler. It measures. An ETF is more like a vehicle. You get in, and it takes you as close as possible to the return that ruler represents. What role do ETFs play in the market? I will summarize it in 3 sentences. First, ETFs turn a portfolio into a product. They make diversification easier for ordinary people. When you buy an ETF, it is like buying a pass. You indirectly own a basket. In the past, doing this was harder, more expensive, and more complicated. ETFs made it simple. Second, ETFs bring intraday trading to funds. That is both a benefit and a temptation. The benefit is flexibility. The temptation is that it makes people itch to trade. Many ETFs were designed as long-term tools, but too often they are used as short-term toys. Third, ETFs make the market structure more efficient. Market makers and the creation and redemption mechanism usually keep an ETF's price close to the value of the underlying basket. You don't need every detail, but you should know this. ETFs don't float freely for no reason. There is a mechanism that ties them to what they hold. But I must warn you, an ETF is not one thing. It is a category of containers. Two products can both be called ETFs, and yet they can contain completely different things. Some hold the S&P. Some hold the total U.S. market, large, mid, and small. Some hold global markets. Some hold sector themes. Some even contain leverage, short exposure, futures, or complex strategies. So when you see the letters ETF, don't get excited first. Ask 3 questions. What does it track? What is the basket? How does it track? Full replication, sampling, or synthetic derivatives? And what are the costs and frictions? Expense ratio, bid-ask spreads, tracking error, tax differences. Once you ask those 3 questions, you stop buying labels, and you start buying exposure. Now we can answer the most common question, and the one people most often compare incorrectly. Between the S&P and ETFs, whose returns win? I'll say it directly. This is not a fair contest, because they are not the same kind of thing. The S&P is an index. It is a benchmark. It is a ruler. An ETF is a product. It is a tool. It is a vehicle. So the correct question is this: can a specific ETF that tracks the S&P follow it closely over the long run? Usually, the answer is yes, very closely, but often slightly lower over time. The reason is simple. ETFs have expense ratios. They have trading frictions like bid-ask spreads. They have tracking error. They may have small cash drag or differences in reinvestment. That slightly lower can feel invisible in the short run, but over decades, compounding magnifies it. So here is my conclusion. Your goal should not be to beat the S&P. Your goal should be to get as close as possible to the benchmark you've chosen, and lose as little as possible to that small gap. And how do you shrink that gap? Not with more complicated strategies, but with clearer choices.
If you take only one new insight from today, I hope it is this. Investing is not about hunting for answers in tickers. Investing is about choosing a direction on a map. The S&P is a window into the strength of America's large companies, but it is not the entire market. An ETF is a tool that helps you obtain a certain exposure, but it is not the exposure itself. And the essence of investment choice is deciding which exposure you are willing to hand your future to, and then being willing to live with its fluctuations for the long run. When you sort these concepts out, something quiet happens inside you. You stop being pulled by labels. You stop being pushed by hype. And you finally know what you own, why you own it, and what role you are playing in the market. I'll see you next time.